Folks, welcome to our analysis of Amazon stock, ticker symbol AMZN. What we're going to talk about in this video is their earnings report. We'll do a deep dive into it. That was released on Thursday evening. Then we're going to talk about their current fundamentals with a particular focus on valuation as well as a focus on accumulation distribution, along with a few other metrics provided by Investors Business Daily. Then we're going to do a deep dive into the charts. And we're going to answer the question, is Amazon a buy, sell, or a hold? And then lastly, we're going to leave off with two ways that this stock could be traded. One of them will be simply using the common shares. Another is going to be a strategy that we love to use here at the Contrarian Trader, and that is called a short strangle. In essence, when you use a short strangle, you are selling a deep out of the money call and a deep out of the money put simultaneously, and you get paid. You generate cash flow. So think of it as being the casino and not the gambler. But before we begin, folks, I'm going to ask you to please smash that like button. I mean, really hit it hard. Do that now. I'll take a 2-second pause. 1, 2. Good. Thank you very much for that. And I also want to say thank you to our sponsor being TrendSpider. Folks, don't settle for ordinary trading software. You need to be able to automate your grunt work and speed up your technical analysis, and all the while improve your accuracy, reduce costly analytical mistakes, and find winning chart setups by using their scanner, time your trades with precision by using their alert system. They're the best in the business. I use them all the time. And in fact, you're going to see me use them later on in this commentary. Head on over to the website over at TrendSpider. They have a 7-day free trial offer. And they also have a demo tour that you can take a look at. I believe in it so much that I give it away free to our silver and gold level members to the Contrarian Trader. So head on over there. Again, use that link below. 35% discount code. That's the cheapest price on the web. So take advantage of it. Oh, yeah, by the way, they just launched their new mobile app. It's outstanding. Let's get to Amazon. Okay, so off of Zero Hedge, Amazon crashes after missing revenues guiding far below consensus. Let's do a deep dive into the numbers. Net sales. $113.1 billion, up $27 billion from the year prior, but badly missing estimates of $115.1 billion. Now, while their sales missed, their EPS, earnings per share, beat estimates. But that just goes to show you how companies, despite the fact that their sales declined, can manipulate the EPS, the earnings per share, by buying back stock, accounting, one-time accounting tricks. So always watch sales, always watch revenues. Very, very important, because that's an unfiltered number. Everything else after that gets filtered. Operating income, $7.7 billion, missing the estimate of $7.82 billion. Now, the one really, really big bright spot was Amazon Web Services. Net sales of $14.81 billion. Up 37% and beating the estimates. Now, here's where the rubber meets the road. Online stores net sales, $53.16 billion, missing estimates, $56.71 billion. And their free cash flow plunged 62% to just $16.146 billion. Sounds like a great number, but unfortunately, well below consensus. Now, if that weren't enough to send the shares down lower, this was the icing on the cake. Q3 net sales, that's the current quarter that we're in. They've given a range on net sales of $106 billion to $112 billion, and that missed the consensus of $118.75 billion. So that's a huge, huge downgrade of expectations. And net operating income, they guided down as well to a range of $2.5 billion to the upper end of the range of $6 billion, which missed estimates, which were at $8.11 billion. So a major, major disappointment on a forward-looking basis. And here's a clear picture of how well the company did during the COVID shutdown. This is Amazon revenue growth, trended up higher dramatically through the shutdowns and the reopening. The Q2 quarter, which is the final blue bar here, was on par with the Q2 quarter for 2019. Now, the real concern here, again, is the forward-looking guidance for Amazon, where in red, this is the projection for revenue growth. This is going to be, if their numbers hold up, the worst performing quarter in terms of revenue growth since back here in 2015. Now, as for Amazon's profit margins, this is a fairly thin margin business. And absent the cloud business, their margins would even be tighter. So it's very, very critical for Amazon to watch their margins. And their margins contracted from 8.2% from the March quarter of 2021 to just 6.8% in the June quarter. Now, I mentioned the cloud business. The cloud business continues to grow dramatically. So along with Amazon Web Services, the cloud business is really helping drive results for the company on a forward-looking basis. Now, this is a chart of Amazon's operating margin by segment, and you can see their international business is just barely profitable, whereas the U.S. business, while it's slowed down, is still helping to drive the company's profitability. Now, Amazon Web Services, which clearly is outpacing the rest of the company's business lines with a profit margin or operating margin of 28.31% in this past quarter, but that's a decline versus the 30.83% from the prior quarter. So while this is not a horrible pullback, what you don't want to see is a trend down, because remember, Amazon Web Services is one of the main drivers of the overall business. And if we see a decline here, that's really going to get reflected in the North American overall operating margins and international. Again, we're just barely profitable on an international basis. So we'll be watching, or Wall Street will be watching with great interest to how the Amazon Web Services business is doing in the coming quarters. Now, Amazon's free cash flow is really a disturbing chart because the trend had been up well before COVID. Free cash flow began a new uptrend in the June quarter of 2018 and peaked in the June quarter of last year. And ever since then, we've been seeing a fairly consistent decline in free cash flow. And this quarter, man, what a disappointing outcome. So we should expect volatility in the shares of Amazon in the near future. Now, here's a concern I have about Amazon and their earnings. I mentioned earlier that their margins are thin. They're expecting a slowdown in their business moving forward, yet they continue to hire new employees. So if the business is slowing and they're hiring new talent, in the short run, I would expect to see more pressure on their margins and free cash flow. Now, as we take a look at the valuation of Amazon after this last earnings report, it's an expensive stock, but it has been traditionally an expensive stock. And the reason why it's been such an expensive stock is that you're buying the best of breed in their business. Now, their trailing PE is at 57.94. That's actually down from last quarter. Obviously, the shares have been under pressure. But when you take a look at the trailing PE relative to a year ago, dare I say, the shares look as if they're discounted relative to the prior year. Remember, we saw a peak in their free cash flow in the June quarter of last year. And ever since, we have been trending down in trailing PE. Now, on a forward-looking basis, current PE 55.56, still a very, very rich PE ratio. but that is down from the end of June, the June quarter, at 57.47, and well below the year ago period at 128.21. And if you're asking whether or not can they maintain this PE ratio for the longer term, sure they can, because take a look at your quarterly revenue growth, 27.2%. Quarterly earnings growth, 48.4%. So the growth story is there. It's just slowed dramatically. Now, taking a look at the rankings as measured by Investors Business Daily, Amazon is a part of the retail internet group with a composite rating of 63, not the best. Amazon is ranked number 8 in the group with Live, if you're questioning who's number 1, Live being ranked as number 1. Their earnings per share, very high score. We already discussed this. Very, very good ratings in terms of EPS. Now, its relative strength rating is very poor. But to be fair, the group relative strength, the overall retail internet group sector, only has a rating of D. And an accumulation distribution rating, meaning are institutions net accumulating? They are now selling Amazon shares as noted by the price action in recent days. Now, a couple of metrics I really, really like here. One, the 3-year EPS growth rate at 55%, and their annual ROE, return on equity, 27.4%. A number in the teens is healthy. A number above 20 is rock solid. That's saying that you have really, really strong management at the helm at Amazon. Now, the beta, this is a measure of volatility, is above 1. Any read above 1 on beta indicates that the shares are very volatile. Good for options traders, especially sellers. Not so good if you're a long-term investor of Amazon shares and volatility keeps you awake at night. Now let's do some technical analysis of Amazon. We're going to begin with a top-down approach to our technical analysis. What does that mean? Well, we like to use multi-time frame analysis, and TrendSpider, who is our sponsor, again, 35% discount code below, they share my sentiment with regard to the value of multi-time frame analysis. And what is that? What that is using not just a daily chart to identify is a stock in an uptrend, because we need to understand the higher level view. Are we in a macro bull run, or are we simply seeing a short covering rally on a daily chart? To answer that question, we need to take a look first at a monthly chart. And you could see here that Amazon is still in a very, very healthy bull run. And in fact, Amazon has been in a trading range ever since July of 2020. This is a multi-month consolidation, and we attempted to break out this past July, but obviously with earnings and some institutional distribution, as I showed you, with the Investors Business Daily data, we saw a bearish key reversal for the month of July. That is extremely bearish. Now, does that mean that it's guaranteed to head down lower? No, it does not, to be fair, because we saw very similar price action back here in October of 2020, but we didn't get a follow through to the downside on a closing basis. Yes, we made a new monthly low in November, but we didn't close there. We rallied back. And we held the support level at, let's call it 3,091. And on Friday, we closed at support at 3224.77, which is a positive signal, but it's no guarantee that we will not continue lower. So right now, were I looking to buy these shares, I would be taking a very cautious approach, a wait and see approach, if you will. And I'll show you why in a moment when I go to the daily stochastics. Let's go to a weekly chart. The weekly chart was very bearish last week. An outside reversal bar, also known as a bearish engulfing of the prior week's move. Generally, that portends new lower lows. The caveat, again, is that we did close at a very, very strong support level. So maybe it'll hold. Volume last week rose above the moving average. So there's your institutional distribution. RSI is in a downtrend, putting in lower highs and lower lows now. Daily chart. Now on a daily chart, You could see that on Friday we had a major gap down. Here's the support level in green that I reference as being a strong support level. But take note of the heat map down here. Take it off, put it back on. It's implying that we have a lot of support down below, and that support is a kind of a range, and it begins at $3,259 all the way down to, let's call it $3,200. And I'm really identifying support and resistance within the very heavily red area, because I do think that we are going to bounce very, very soon. But I think that bounce should be faded. I think that you're going to see sellers move in and sell any rally. Why? Well, you have a ton of institutions out there that own Amazon shares, and they're not going to allow these shares to just drop down. They're going to carry Amazon a few rounds, trying to get retail money in there to get excited about the stock. Don't be surprised you see a couple of upgrades of Amazon stock, all with the intention of getting you excited. Don't let them take parking space up in your head. A lot of technical damage has been done here. Here, let's bring up the automated trend lines. This is the algorithm. You can see that on Thursday, just prior to the close, we bounced off of a rising support level. On Friday, we cut right through it like a hot knife through butter. I'm going to take off the heat map here, and you can see that there's another trend line immediately below. I'm going to set an alert here. I'm going to keep a wee bit of sensitivity on, but I want to get notified if we break through, touch, or bounce. Now, I want to be clear that I will not be buying Amazon as an investment. It's purely a swing trade. We opened up a small position as the shares were getting hammered after hours, after their earnings came out, and we'll be looking to add more at a very, very strong support level. Now, why do I want to look to sell that rally pretty quickly? Well, I'm going to bring up the stochastics. These stochastics are now well down below the 50 level. Right here is your neutral line. You don't want to see both lines on Stokes, the fast line and the slow line, declining down below the 50 level, because rallies tend to fade, folks. So that's why I'm saying any rally in Amazon is probably going to get sold into this coming week until such time as we enter oversold levels on the stochastics, and then we'll probably get a nice counter trend move. Also take note that the algorithm, I was going to draw the line, but the algorithm did it for me. We have a double top on a daily chart, which means nothing really until such time as you break down to a new lower low. We did that on Friday. This was the lower low. A gap down below 3506, spot 88. That marks a new downtrend in Amazon shares. So the path of least resistance at current, despite the fact we may get a day or two of a rally back, is now to the downside. So be very, very careful. Now let's take a look at seasonality. How does Amazon normally perform during August and the fall months? This is data, and this goes, anybody that's subscribed to TrendSpider gets this. This is data that goes back 14 years to 2007. The July quarter, generally very good, but the August through October months, they're about 50% on average. They're up, with October being tied as being the worst month of the year, along with December, which is surprising. Usually you get the Santa Claus rally. And, of course, February right here. So we're not entering a seasonally favorable period of time. So the time is right for a correction in the shares of Amazon. But with that correction brings opportunity. Now, I'm going to keep these Stokes on here because I really use them as a tool to help identify when it's safe to go back in the water, meaning when it's time to buy the shares. Now, as I mentioned, I did buy some Amazon shares because I expected a counter trend rally. It never happened on Friday. There was a lot of institutional distribution. So there are a couple of ways to play this. As a short-term swing trader, I don't day trade, so I'm not going to offer advice on day trading. As a short-term swing trader, I would look to see whether or not we hold this support level I identified earlier and I would fade any rally, book my profits, and exit the shares, because I do think that there's going to be more selling to be had in the coming weeks. Now, as an investor, I'll begin with the monthly chart, and I'd be looking to see Amazon retrace all the way back down here. I know the folks out there that are long certainly don't want to hear this, but remember that stocks are cyclical. A couple of the two certains in the stock market is that stocks will go up and stocks will go down. So I want to know when Amazon hits this support level. And it's at that time I'll start analyzing the daily charts, the weekly charts, to see, are we seeing a decline in selling pressure as measured by volume? Are we seeing some stealth accumulation by institutions? And on a retest, if it occurs, may not occur, but on this retest, we can make the determination of as to whether or not Amazon is investable. We're going to keep this live for the next 60 days, and our alert is set. And it's right here. I have a couple of them set, I believe, on our sidebar. You can see on the monthly chart, your stochastics are beginning to roll over. They're still very healthy, but they are weakening up. Weekly chart. Here's our monthly support where we have an alert set. I'm going to create an alert here. I want to know if we break this support level, and it goes on our watch list if we break support. And we'll keep this active for 14 days. So you can buy the common stock if we hold the support level for a swing trade, a short-term swing trade. If it breaks the support level, I don't know whether or not I would short it, but I wouldn't buy it, that's for sure. I would wait for this support level to get hit down here at around $3,000 to $3,100 per share. And let's face it, given last week's price action, we could be there this coming week. Now, there's another way to trade Amazon, and that's by the usage of a strategy that I like to use called a short strangle. Now, here's our probability calculator. We plug in price targets, which give us a strong probability of profit. There's an acronym for it. It's called POP, probability of profit. And in this scenario, I'm using the closing price action on Friday, and this is obviously subject to change, and as might these price targets, to both the call side and to the put side. And with this scenario, we would sell one contract, which is 100 shares of Amazon, 3,800 strike price expiring September the 17th. At the same time, we would sell one contract of the 3,000 strike. Remember, we have a support level right there. So that's how we tie in technical analysis with options trading. Not many people do that. That's what we do differently here. And TrendSpider is a great tool to use. So our alert is set down there. So if we do move down towards this price target, and by the 17th of September, the shares are trading at or below that mark, well, we'd have those shares assigned to us. But that's okay, because we've been paid a premium. Here's the options chain for the expiration date we're looking to trade. Again, September the 17th, expiration. Here's the put side. We would get paid a premium, 3,000 strike to the put side. We always use the midpoint. The midpoint is at current at 26.55. So let's say we trade one contract. That's $2,060.55 that automatically gets put in our pocket. So let's bring up our calculator, because now we're going to calculate our basis cost. Then we're going to take a look at the call side contracts. Here we are. Here's our 3,800 strike with our midpoint of $12.12. We'll round that down. Again, let's take our calculator out. Add up. $12.12. So we would collect a premium of $38.67 per contract traded. So if we say, okay, we're going to trade one contract, we multiply this by 100. Because remember, each contract is an equivalent of 100 shares. And we collect day one, $3,000 $867, we put that in our pocket. Now, that doesn't mean we're going to get paid that. Normally, I would book profits at 50%, at or around. So now let's take this number here, 3867, and go back to TrendSpider really quick and say, okay, here's 3,800 up here. We'd have to make new all-time highs. That's probably not going to happen by mid-September. So 3,800, if the shares were called away from us, but still traded down below by the end of business on September the 17th, down below $3,838.67 per share, we would still book a profit because our basis cost is not $3,800, it's $3,838.67. Now, what if our put side gets tested? Well, we're looking to sell the 3,000 strike. Our basis cost, if the shares are assigned to us, is 3,000 minus 38.67, and that's equal to a basis cost of $2,961.33. So you could see how this strategy can help reduce your basis cost, and the contracts would expire worthless if you held them to expiration, if they traded within the range of 3,800 to the upside and 3,000 to the downside. So this is a option strategy. So two ways of trading Amazon: common shares and options. Frankly, I prefer the options route better because I'd like to get a discount on my shares, especially when I know that there's probably more pressure coming on these shares in the near future. Folks, I just modified the calculator because the system logged me out, so it didn't change the probability. So the real probabilities are different from what they were earlier. The real probabilities of them trading between the two ranges has actually improved since I re-logged in to 86.87%. So the probability of the shares trading by September the 17th above $3,800, less than 4% probability. And the shares trading below 3,000, less than a 10% probability. This is a short strangle. So if you want more coaching on these, join the Contrarian Trader 14-day free trial offer. I hope you got some value out of this, folks. Please leave a comment below, like, subscribe, and don't forget, take advantage of our 35% discount code below, TrendSpider, and everyone have a profitable trading week. Be well.